Hello everyone. Try to recall in my previous session, I discussed cost of equity, different approaches of calculation of cost of equity. I hope that session was interesting and you could learn how to calculate cost of equity. Now, the next important component of financing is retained earning that I'm going to discuss. And once you are able to know how to calculate cost of debt, cost of preference, cost of equity, cost of retained, then only you are going to combine. So you have to calculate weighted average cost of capital or combined cost of capital, which is actually cost of capital to the company. Company may raise fund from different sources, but these funds were raised from different sources. So when you combine, you calculate the average using their respective weight, then only you will be able to know what is the hurdle rate, what is the actual cost of capital to the company. We are calculating a specific cost like cost of debt, cost of preference, cost of equity, and now you will be learning cost of retained earning. So after knowing the computational procedure of a specific cost, you will combine and then you will come to know how much is the exactly cost of capital to the company, and that knowledge will help the company a lot in capital budgeting decisions, in capital structure decision, and to evaluate the performance of the company from different angles. So be with me. You are going to learn how to calculate cost of retained earning, what exactly retained earning is, and then on the basis of cost of each and every specific sources of fund, you will be learning weighted average cost of capital. So in this session, you are supposed to learn cost of retained earning and weighted average cost, its calculation, and some numerical problems to make the concept clear to you. So these are the learning objectives of this session. Now, introduction to cost of retained earning. Actually, what is retained earning that you need to understand? Retained earning is the part of earning which belongs to equity shareholders, but it has not been distributed to them. It has been kept by the company in the form of reserve for reinvestment purposes. So instead of distributing profit in the form of dividend to equity shareholders, it has been kept by the company. Actually, equity shareholders are the owner of the company. If you are the owner, you can take the profit, you can spend that profit, or you can reinvest that profit. So that decision has been taken by the company not to distribute dividend, rather make reinvestment of profit which belongs to equity shareholders. So this profit, but sometimes people think whether this source of fund is free of cost or some cost is involved. Try to think. Suppose company is in need of 50 crore rupees and they are searching the opportunities, what are the opportunities available, and they found it is available if they raise this money by issue of bond, or if they go to any bank and they borrow money, then they have to pay 10%. But it had been suggested by your top authority, instead of borrowing money, the same fund which is available in the company can be used in the form of reserve. So that reserve fund has been used. If suppose reserve fund is not available, then company would have borrowed. So you can say this is the opportunity cost to the company, but it belongs to equity shareholders. But there's one difference, or you can see when we talk about cost, it belongs to equity shareholders. But the only difference is if it is distributed to equity shareholders, then equity shareholders would have been taxed. For example, you are the investor and company distributed this profit instead of kept in the form of reserve. The profit was distributed to you. So that dividend income would have been included in your total income, total taxable income. Suppose you are in tax bracket of 30%. So 30% less amount you will be getting or will be available to you for reinvestment. So if cost of equity, whatever is cost of equity, that cost of equity fund you have to reappropriate. You have to reappropriate by reducing to the extent of amount of tax. If you are in 0% tax bracket, so it will be 0%. some of the investors may be in 5% or 10% or 20 or 25 or 30% tax bracket, depending upon the scenario prevailing in a particular country. Second difference is after payment of taxes, whatever is the remaining amount, you are likely to make reinvestment. And if you reinvest, again, you have to pay some brokerage. So that brokerage cost will also be subtracted. So the only difference between cost of equity, actually it is similar to cost of equity, but from cost of equity, you have to reappropriate. Suppose 30% tax has been paid. Suppose cost of equity is 20%. You receive this amount, you are likely to pay 10% tax. So if it is paid to you, so this amount will be 18% to you. Got the point? 18%. Why? Because you are in tax 10% tax bracket. If you receive 10% tax, you have to pay. So remaining amount will be 18. And if you invest this one, suppose 2% is brokerage cost. So again, 18% into 0.98. So that will be the cost of retained earning in that way. So with the example, it will be later on when I will take numerical example, it will be clear to you. But why it is important to know about cost of retained earnings? It will help in calculating weighted average cost of capital because it is also one of the source of capital for the company, just like equity shares, preference shares, debentures. So unless you calculate, if you have retained earning and you are not calculating, so the cost of weighted average, or you can say weighted average cost of capital, will give you wrong figure, and wrong figure will lead to take wrong decisions in the company with respect to capital budgeting, evaluation of financial performance, or deciding financing aspect of the company, or deciding the capital structure of the company. So your decisions will be wrong. Assist in financing, or rightly it has been given here. Evaluate the borrowing alternatives. If you have so many alternatives available in the market, and you want to evaluate the most appropriate source of funding for the company in the best interest of the company, then one of the component is retained earning, and its cost is mandatory to calculate. Then only all these things will be feasible. Otherwise, your total calculation will be wrong, and based on this wrong calculations, you will take many decisions, and most likely all those decisions will not be appropriate, will be faulty, and the company will suffer later on. And that's why it is important for all of you to know how to calculate retained earning, cost of retained earning. So as I told you, uh, the only difference is whatever is the cost of equity, 1 minus t. If you have received, had you received the amount of dividend, you would have paid certain amount of tax. Depends upon in which category you are falling. You are in 20% tax bracket or 30%, you are likely to pay tax, or 10%. It depends person to person. Then after payment of taxes, the amount available to you, if you reinvest, you plan to reinvest, then again you have to pay some brokerage cost. So whatever cost you have paid, it will not be your investment. Remaining amount after subtracting the amount of brokerage will be your investment. So in that way, uh, cost of equity will be transformed into cost of retained earning. So with one example, suppose this one. A firm's cost of equity is given. A firm's cost of equity. So when we are calculating cost of retained earning, it is equal to cost of equity 1 minus T, that is tax rate, and further it will be appropriate 1 minus B, that is brokerage cost. So cost of equity is suppose 20% and tax rate is 30%. So 1 minus 0.3, 1 minus 0.2% means 0.02. So if you multiply 20% by 0.7, further multiplied by 0.98. So in that way, it will be 14% multiplied by 0.98. So it will be something. So this will be the cost of retained earning in this case. So it has been already calculated here. You can see 20 14% multiplied by 0.98, it will be equal to 13.72%. So in this way, this is the simple formula of calculation of cost of retained earning. So after this, once you are able to calculate, once you are able to know how to calculate cost of each and every source, next important thing will be, the final thing will be to calculate cost of capital for the company. Cost of capital for the company. Capital means long-term fund, and long-term fund comprises of equity, preference, debt, retained earnings. So all these components already you have learned how to calculate. Next important task will be to calculate weighted average cost, and this weighted average cost is representing the composite cost, and this cost becomes the hurdle rate, minimum rate of return that company must earn. In the beginning, definition of cost of capital was given a minimum rate of return that company must earn on its investment activity. So once you are able to calculate weighted average cost or composite cost, it is the minimum cost or it is the minimum rate of return that company has to earn on its investment activity. If return on investment is 12%, and aggregate cost is 13%. So investment activity, that investment decision you should not take. There will be a loss because you have to pay 13%, you are getting 12%. But if cost is only 8% and your return is 12% on investment, then 4% is profit. So this margin you have to expand. So in two different ways. One is you can minimize the cost and you can maximize the return on investment. So in two different, to minimize the cost and to maximize the return on investment. So investment decision has objective of maximization of return. Financing decision has objective of minimizing the cost. So if these two tasks, these two functions are performed properly, so aggregate or you can say overall impact on the business will be positive. All will get benefit, shareholders will get benefit, company will get benefit in terms of value creation. So it is called hurdle rate, minimum rate of return on investment, and cutoff rate. Company is not going to compromise investment decisions below the cost of capital. Why working or weighted average cost of capital is important? So you have to understand why weighted average cost of capital is important. It is used in capital budgeting. You are not going to compromise return on investment below weighted average cost. Just like I gave example, your cost is 8%. So at least return on investment should be more than 8%. Then only you are going to accept investment proposal. It will help in assisting in financing decision because we have to get finance from different sources and cost of each and every specific source is different, so you have to make combined effect in order to minimize the, your objective is to bring down the cost of capital or overall cost of capital. Evaluate borrowing alternatives. So on the basis of calculation, one combination of fund, another combination of fund, or you can say another combination of fund. So each and every combination of fund you have to evaluate. So wherever aggregate cost of fund is minimum, you have to go for it. Now, as far as measurement of overall cost of capital is concerned, the first step is you have to assign the weight of a specific cost because certain amount has been raised by issue of shares, equity shares, preference shares, debentures, retained earnings are there. So what is the weight or percentage or proportion of each and every source? Suppose 40% is equity plus 20% is debt plus 10% is preference. So 6 and 30% is retained earning. So you have to assign the weight. Like equity weight is 0.4, this is 0.2, this is 0.1, 0.3 like this. You have to assign the weight. Then cost of each and every source which you have learned how to calculate, you will multiply it with the weight and then total weight divided by, or you can say total weighted cost will be divided by total weight. You will get weighted average cost. So in this way, cost of debt, whatever is cost of debt, suppose it is 10%, I just assume its weight was zero point 0.2. So you will write zero point 0.2 plus cost of preference was suppose 9%. Its weight was suppose point, like in this case, you can say preference weight was zero point 0.1. So it will be multiplied. Cost of equity, suppose cost of equity has 12% return and its weight is given here is zero point 0.4 plus cost of retained earning. Suppose already you have calculated cost of retained earning as 10% multiplied by its weight is zero point 0.3. So in this case, 10 into zero point 0.2, it will be 2 plus 9 into zero point 0.1, it will be 0.9 plus 12 into 4, 4.8 plus 10 into 3, 10 into zero point 0.3, it will be 3. So if you just total 4, 5, 6, 7, 8, 9. So if you just make total, that will be the weighted average cost of capital. So it can be used 4, 5, 6, 6.8, 7.7. So it is 8%. So in this case, weighted average cost will be 8%. So just like this, you have not to use simple, like there's a confusion like a simple average and weighted average. So if like 14, 11, 9, 10% is the cost of each and every source, you just take the average of these four, you just make total like 25 and 9, 36, 46 divided by 4. It is not like this. For example, one question is given, market value of equity is 15 lakh, market value of debt is 5 lakh, total fund used by the company, suppose 20 lakh, cost of equity is 10.5%, cost of debt is 6%, already calculated the way you have been taught earlier, already calculated. So on the basis of this, out of 20 lakh, 15 lakh is equity, so its weight is 0.75 or 75%. Out of 20 lakh, 5 lakh is debt. Here you can see 5 lakh is debt, so its weight will be 0.25 or 25%. So if you just multiply cost and weight, cost and weight, and make total of this, make this total. So 9.375 will be the weighted average cost of capital. This is pre-tax. Suppose tax has not been considered. It is given, suppose cost of debt is 6% here and tax rate is 25%. So first of all, this 6%, 1 minus t, that is 20.25%. This you have to subtract. So 4.5% will be cost of debt and cost of equity 0.75% is weight and 10.5 here it is 10.5%. So if you make total, it is 9% here. So after tax, cost of weighted average cost of capital will be 9%. So in this way you have to calculate. For example, one question is given here. A company is using different sources of fund like debt 12,000, preference shares 15, equity shares 18, retained earning 15. So these are different sources of funds used by the company. So if you make just total of this, you will get 15, 18, 33, 33, 15, 48 and 12. 60,000 total fund used by the company. So out of 60,000, what is the weight of 12,000? So it is 20%. How to calculate this 20%? 12,000 divided by 60,000 into 100. So there it will be 20% or 0.2. Similarly, for preference, 15,000 divided by 60,000. So it will be 0.25. Similarly, 18,000, the weight of equity is 18 out of 60. So what is the percentage? It will be 30%. Similarly, for retained earning, its weight is 25 or 0.25, 25% or 0.25. Now you have to multiply, or for example, cost of debt is already given 4%. The way you have learned how to calculate cost of debt, it is 4%. Individually, already you have calculated 8% is cost of preference shares, 12% is equity. Try to think in a practical way. Suppose a company is there, you are working in a company, and you have been asked to calculate overall cost of capital. So you will check what are the different sources of funds used by the company. First thing you have to see. Then how much amount has been mobilized by issue of these specific sources of funds. Then next thing you have to make total of this. Next one is you have to find the weight. How much is the weight of each and every source? So it is 20%, 25%, 30 and 25. So its total should be 1 or 100%. Then individually, cost of capital, cost of debt, cost of preference, cost of equity, cost of retained earning has been calculated. It is 4%, 8%, 12%, 11%, the way you have learned in previous sessions. Next step will be to multiply this one. Suppose this is 1, this is 2, this is 3, this is 4. So how to find total? 3 multiplied by 4. This one will be multiplied by 4. So 0.2 is multiplied by 4. It will be 0.8. Similarly, 0.25 multiplied by, so you can see like this, it is 0.8. 0.25 multiplied by 8%, it will be 2. 0.3 multiplied by 12%, it will be 3.6. 0.25 multiplied by 11, it will be 2.75. So here 9.15 will be the weighted average cost of capital. So in this way you have to learn how to calculate cost of capital. One more example you can say. I hope this is clear to you. It's very easy process. Once you are able to know what are the different sources used by the company, how much amount of fund raised from different sources, then you have to calculate the weight, then cost of each and every source you have to calculate, cost of equity, cost of preference, cost of debt, cost of retained earning. Then you have to multiply these two figures to get this one and make total of this. So this is called weighted average cost, and this is called hurdle rate, which you have learned, or this is cutoff rate. Companies never going to compromise return on investment below this, because at least this fund, this much of cost must be recovered from its profitable activities or from projects, from investment. Now one more question is given here. Suppose ABC Limited has the following capital structure: equity expected dividend 12%, or you can say cost of equity is given 12%. Total amount raised was 10 lakh. 10% preference shares were raised. Total amount was 5 lakh. So cost of preference is 10%. 8% loan, 15 lakh fund was raised, and it is assumed tax rate is 50%. So what will be the solution in this case? Again, the same step you have to follow. You have to write total equity. First of all, equity, preference and loan. There were three sources only. So all the three sources you have to use. Here it was 10%. Now total amount raised 10 lakh, you can see is equity. So where equity capital is written 10 lakh. 5 lakh is preference, so 5 lakh is written here. 15 lakh is debt, so 15 lakh is written here. So if you write the total, just make total of this. So total is 30 lakh. Total fund used by the company is 30 lakh. So out of 30, what is the percentage of 10 lakh, which is the source of equity? It is 33.33, right? How it has been calculated? 10 lakh is the amount of equity raised out of total capital of 30 lakh multiplied by 100. So it will be 33.33%. Similarly, 5 lakh is the preference capital. Its component, its weight will be 16.67. How to find it? 5 lakh was the amount of preference capital out of total fund 30. So if you just multiply by 100, you will get 16.67. And out of 30, 15 lakh, it's very obvious, is half. Half of the fund was raised by issue of debt, so it is 50%. So in this case now, you have calculated the weight of each and every source, weight of each and every source, 33.33, 16.67, and 50%. Next step is to multiply this one. One more adjustment you have to do. Uh, Cost of loan was 8%, but here it is written 4. Why it is? Because cost of loan 8%, 1 minus T, tax rate is 0.5. It is given here 50% is tax rate. So whatever is the rate of interest, which is nominal rate of interest on loan 8%, but effective rate of interest or effective cost of debt to the company will be 4%, half of this, because of 50% tax rate. If tax rate is 30%, then only 70% will be the cost. So in that case, 5.6%. So here it is 4%. How it has been calculated? By using this 8% cost of loan, 1 minus tax rate. Tax rate is 0.5. So 4% is after tax cost of debt. So if you multiply, next step is 12 multiplied by 33.33. So it is 3.99. 10 multiplied by 16.67, 4 multiplied by 50%, that is 2, and make total of this 7.66 will be the composite combined cost or weighted average cost. So on the basis of weighted average cost, you can say this is called hurdle rate, or this is called cutoff rate, or this is called actual cost of capital, because capital comprised of equity, preference, and loan. So this is the actual cost of capital which is used by the company. So you have to learn how to calculate cost of weighted average cost, and knowledge of this weighted average cost, composite cost, or combined cost will help you in making lots of decisions related to capital budgeting, related to financing, capital structure decision, evaluation of the performance or evaluation of different available opportunities with respect to raising fund, everything you can do. So once you are doing it sincerely, once you have got the knowledge and you apply this knowledge somewhere in practical condition, your company is likely to get benefit by virtue of your knowledge. And if that knowledge is applied, obviously shareholders will get benefit, company will get benefit. As a professional, you will also get development, you will also be promoted, you will be given incentives for supporting the company, facilitating the company by virtue of your knowledge. So, as far as summary of this session is concerned, I have discussed what is retained earning. Sometimes people think retained earning cost is internal source of financing. Cost should not be considered for that, but in this session you have got the logic why retained earning should be considered and how cost of retained earning should be calculated. It is very similar to cost of equity, but slightly different from cost of equity. Like when we talk about cost of equity, if we subtract tax aspect and brokerage aspect, these two aspects are subtracted, then remaining will be the cost of retained earning that you have learned. So once you are able to learn cost of each and every source, next important thing will be to calculate cost of capital, weighted average cost of capital, not simple average, weighted average cost of capital. You might have learned in case of statistics, there are so many forms of averages, like you can say simple average, simple arithmetic mean, harmonic mean. geometric mean, and weighted average. All these are different, all these are not same, though all are averages, but all are used in different conditions that you need to understand. Somewhere you might have studied in statistics. So weighted average you have to calculate, not like simple average. Like in one of the slide I give example, if like 5, 6, 7, 8, these things are given and no anything else and no any other information is given, you will use simple average. But apart from this, some weight is given, just like amount of capital is different. Cost is 5% for equity, for debt, for preference, for retained earning, and their amount of capital vary. Suppose it is 20 lakh, it is 40 lakh, it is 70 lakh, and it is 60 lakh. So if weights are different, simple average will not be used. If weight is not given, you have to use simple average. But apart from these rates, their weight is also given. So weight will also be considered while calculating average. So in case of sources of finance or while calculating composite cost or weighted average cost, weight of each and every source is normally vary, and that's why you have to use weighted average to find the real cost of capital. And real cost of capital is useful, all of you know, in better way, in financing decision, in capital structure decisions, in capital budgeting, and to evaluate the financial performance of the company. So in that way, the knowledge of uh, cost of capital will help you in number of ways. If you are working as an executive, you can facilitate the company in terms of calculation, and the rest of the decisions will be better if cost of capital is calculated in proper way. But if cost of capital is not calculated properly, rest of the decisions related to capital budgeting or investment related decisions or financing decisions will not be up to the mark, and company will not be getting the expected benefits which they are supposed to get. And that's why it is important. Again and again I'm telling, whatever you are learning, before starting your learning, you must know, or it should be in your mind, what's the benefit of learning whatever is suggested by different resource person in different session. Not only in this, but anywhere. Like if you attend any class, before attending the class, you should learn uh, what's the benefit of those inputs given by the teachers. What's the benefits of what is given to you in this session? What's the benefit of attending this session? What's the benefit of completion of financial management program? What's the benefit of completion of any other program? So if you know the benefits, if you know the importance, utility, then only you will take interest, and your performance will be better. So this is all in this session. Thank you so much. This is all about cost of capital aspect. Though things are many, like you have got the idea, you have got the reference from these sessions, but some other things, for some other latest things, you can go through the literature, you can go through other some softwares are also there. In Excel also you can calculate. So this is all about cost of capital on my part. Thank you so much.